following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today here in late June as we go through some little market hiccups there. I know a lot of you out there are probably nervous about what's going on in the stock and bond market. We'll take a look at that here in a little bit. But I wanted to start off with an article because in times like this, people tend to run to something that they think is going to be safe and secure. So I want to talk a little bit about this article. It was in the Journal yesterday, Wall Street Journal, about misjudged annuity guarantees may cost life insurers billions. And we'll talk about that in just a minute. But if you have any comments or questions for the show, we'd like to hear from you. The phone number here is 252-633-0107. The email to the show is allthingsmoney@dlblain.com. And, of course, you can head on over to the website at dlblain.com. Big Contact Us button there in the top right-hand corner. Okay, so back to the story. This just came out yesterday. As you know, if you've listened to the show at all, I'm not a real big fan of annuities. They generally overpromise and underdeliver. However, there was a small window there, people that bought annuities with big guarantees right in 2008. There for a number of years were looking pretty good because as the value of the markets dropped, they had this guarantee built into their annuity, and so they were guaranteed to get so much a year. Of course, they pay for that privilege, and now, you know, that we're a few years beyond that, a well-diversified portfolio has more than eclipsed the prior values. But anyway, we'll talk about that on another show. What I want to get to here is one of the reasons I don't like annuities is you're essentially turning your money over to somebody else, and you're giving up a tremendous amount of control. And I like having control of money, and when clients come to us, we manage it for them. We take that worry off of their mind. And when you give your money to an insurance company and they're an annuity, you are beholden to their rules and regulations. And so this comes out yesterday. It says, and I'll read it to you, this was Leslie Sissom, life insurers in the U.S. face charges against earnings potentially totaling billions of dollars from miscalculations about the number of customers who would exercise lifetime income guarantees sold with retirement products known as variable annuities. And so what's happened is the insurers who you're trusting and counting on to have your money have made a huge miscalculation. It says over the past couple of years, many insurers have clamped down on fund choices, raised fees, forbid additional account contributions, and sought to buy back the contracts. So basically what's happened is they went out there and this was the hot product, and to gain market share, they were just promising anything. I mean, literally promising anything, giving it away. We see this not just in the annuity business, but in the life insurance business. You'll see it go through phases like this. But they're simply not pricing their product correctly. We see this happen in the long-term care industry. And remember, whenever you're dealing with a life insurance company or any type of insurance, auto, home, liability, anything, just keep in the back of your mind that in aggregate, the insurance company has to make money on that type of policy. So if you look at all the life insurance policies in force out there, the young breadwinner, male or female breadwinner in a household that dies at age 30 with 3 kids and has a big life insurance policy, yes, that helps them, and I'm not against that. I think you should have that. But remember, when you're buying the policy in aggregate, the life insurance company makes out better by selling life insurance than the individual policyholders. And they do this a couple ways. Number one is that people buy, that they're able to invest their money, the insurance company is able to invest the premiums at a faster rate and grow their money at a faster rate than the benefits they have to pay out. Number two is people live longer and are healthier than they were, 30 or than they anticipated 30 years ago when they sold the policy. And then another reason is people simply pay in for a while and then stop paying. So they put all these things into a calculation, and at the end of the day they make money. So they do the same thing with annuities. As they look at, okay, you're going to give us this lump sum, say $1 million, you give it to us, the insurance company, we're going to guarantee to pay you a certain amount of money at, maybe when you reach 65 for the rest of your life. And so they take that money and they invest it. They collect fees on the investments. They collect annual fees, mortality fees, all sorts of fees. And at the end of the day, in aggregate, they make more money than the people that invest in them. Well, what we're seeing here is that some of the guarantees that they made were a little bit too generous. And so in the latest here, Hartford Financial Services Group is requiring, and I'm going to underline that and emphasize that, Hartford Insurance is requiring that owners of certain of its guarantees move at least 40% of their money into bond funds and lose their guarantee if they fail to transfer the money out of stock funds. So within the annuity, you purchase an annuity, and you as the owner of that annuity contract historically were able to decide if you wanted to invest aggressively in mostly stocks or mostly bonds or whatever. You were allowed to pick what you wanted to. Well, here's an example where Hartford is coming saying, whoa, wait a minute, you guys can't do that anymore. You must move 40% of your money to bonds. And this was part of the notice. It says, if you do not allocate your contract value in accordance with the investment restrictions by October 4th, the guarantee will be revoked. According to a letter Hartford is dispatching to its customers this month, with the words, will be revoked in boldface. So here's your guarantee that you thought you were sailing along, and now they're coming back and they're saying, well, they're going to revoke their guarantee if you do not move the money. So that's one of the things. You've given up a tremendous amount of control and having the insurance company dictate what you can and cannot do with your money. Most insurers, the reason for this, most insurers have figured out a way to hedge the market. So there are enough derivative products out there that they can hedge a lot of the exposure to equity risk. But what they haven't been able to figure out how to hedge, and this kind of leads into what we're going to talk about next segment, what they haven't been able to figure out is how to hedge the, quote, less easily hedged and more unpredictable policyholder behavior. And so what's happening is the policyholders are making investment decisions that are just completely unpredictable, and so the insurance company is having a hard time keeping up with the guarantees that they promised due to the investment choices and what the investors are doing. Anyway, we'll finish up on that topic when we come back after the break, and we'll also talk about some of the rampant fear that's going on in the marketplace today.